What's interesting about the trillions upon trillions of dollars in the different markets around the world is that when fear takes hold, it tries to cram through a narrow exit all at the same time. That panic gets worse and worse, and the contagion spreads to assets thought to be sheltered from the issue at hand. Today, with complex derivatives which have become so pervasive, every single corporation and financial instrument can be wiped off the face of the earth in an instant. You came here for the truth, so let me unveil that for you. Today we are going to talk about various topics in line with the global economic collapse. I have a lot to cover, and I wanted to get into the issue of Deutsche Bank first. Deutsche Bank said to lose money on risk management trades. They were actually trying to protect themselves and only made matters worse. Deutsche Bank, the troubled German lender, sought to minimize risk at its U.S. equities business. Instead, the bet ended up in the red. Now, we're talking about the U.S. side of this company, but of course, there is always contagion. Understand how that works. This is one company that has been involved in scandals after scandals and crises after crises. It doesn't seem to stop. Traders in New York pool billions of dollars of positions into one portfolio known as a central risk book in an attempt to avert losses and potentially make more money. When you look deeper into this, it starts to look a lot like the derivatives garbage that we saw back in 2008. Of course, it's different in a way, but let me continue on. Yet the wagers stumbled, leading to a $60 million loss this year. The fallout forced Deutsche Bank to slash the book size, and it goes on to talk about other details. Central risk books have become a trend at some of the world's biggest investment banks. Instead of dozens of workers across numerous desks working to limit possible losses, trades are transferred to a single CRB where they are managed by a small team, often with the help of algorithms. But at Deutsche Bank, part of that strategy didn't perform as well as desired. Doesn't that give you this whole 2008 vibe all over again? I understand it's not exactly the same situation, but it makes me a little bit, gives me that eerie kind of feeling. Let me know what you think about that. Here's the chart which shows us Deutsche Bank's equity woes. The German bank's revenue from equities has fallen for 13 quarters in a row. When you look at this, you have to go deep into the detail of not just one issue, the one I'm presenting to you right now, but look at how they're layered. There's one after the other after the other. All of these add up to a possible and potential crisis. And all it takes is a spark. Just a spark. And it will set this ablaze. Now that's Deutsche Bank. I will constantly cover this company, tell you what's happening. Last time I checked, it was hovering just above €8 at a record low. Now we can see that they have made the claims. This is contained. This is not a problem over here. It's a problem over there, referring to the US. Of course, nothing could be further from the truth. There is always going to be systemic risk and contagion present, particularly today because of how pervasive the derivatives are. So let's look at this. GE could be a $41 billion problem for big banks. When it comes to US banks lending risk, it doesn't get much bigger than General Electric. The 5 biggest Wall Street firms have committed to lending at least $3.5 billion each to the industrial giant facing concerns about the sustainability of its debt. Imagine all of these massive corporations. They own each other's debt. They own debt of different countries. They purchase it as an asset to produce income for them. However, when they start to default on that debt, that company starts to get burned. And if it bought a lot of the debt, then you have a big issue. We find this occurs many times in history, whether it's a government, whether it's a corporation. It could happen to anyone. Doesn't matter how big a country is, doesn't matter how big a corporation is. They can all default, at least partially, at least somewhat. And they do this in part of a restructuring program that we have seen countless times since the financial crisis. GE has almost $41 billion in credit lines it can draw from. If fully tapped, the two main credit facilities would rank as the largest loans to any US company that go beyond next year. GE had used only about $2 billion of the available credit by the end of the third quarter, leaving itself ample room to pull more if necessary. So don't worry about it. Everything is just fine. Bloomberg said so, and there's really no concern here. Okay. Potential GE exposure, 6 banks have committed $20 billion to a credit line. And look, it goes all the way around the world. But primarily we're looking at US companies, including the big boys, JP Morgan and Goldman Sachs. $3.5 billion each. Looking at this has to be a reminder to everybody that all of these companies are on the hook if something happens to GE. Remember that. A decade after the financial crisis, there is a new breed of risk takers in the US housing market. This systemic risk goes just beyond what your imagination can come up with. During the boom, before the bust, lenders made mortgage loans to countless buyers who couldn't afford them. Lenders later wrote off many of the loans, but borrowers' obligation to pay remained. Today, in an improved economy, a ragtag group of individual investors plus some Wall Street giants are buying these old loans and trying to tease value out of them. Look at what they're doing today. They had people purchasing homes they couldn't afford. So suddenly, there is a market now for people who want to take some risk. Check this out. The trade goes like this. Buy mortgages available for very low prices because no one has made a payment on them for months or even years. Non-performing loans, they are called. I talk about this all the time, NPL or non-performing loans. Track down borrowers and let them know that they have a new creditor. Tell them that they need to resume payments at least at a partial level, perhaps offering to modify the terms. Threaten foreclosure if necessary. If all goes well, collect on the debt or resell the mortgage as now a re-performing loan. This is going to be absolutely disastrous because these people who are pushed to the edge and couldn't pay before, haven't paid for months and years in some cases, they're probably in the next crisis, unfortunately, going to suffer yet again. These people will default on their loans to these individuals, and it will be these individuals, including Wall Street, who are going to lose. The defaults are going to spread, and it's going to be yet another problem that will need to be faced at some point in the future. It's not if, it's when. A $9 trillion corporate debt is bubbling in the US economy. I talk about corporate debt. Actually, if you look back not that long ago, I did a video about corporate debt and I broke it all down for you. But essentially what we have here is yet another layer. Companies are carrying a $9 trillion debt load, posing a potential threat should the rates continue to rise and the economy weaken. Most Wall Street bond experts think that the issue is contained. Have no fear. Don't worry about it. Okay? Don't get scared. CNBC wants you to be calm. For the next 12 to 18 months, though one says the market's angst is not misplaced. Goes on to talk about the details. And here, this is another issue that could easily, very, very easily spread. Now, another problem here is when you have these mergers and acquisitions, and this happens to be one that's very relevant to today. Amazon bids for Disney's 22 regional sports networks, including Yes Network. It goes into the details. Essentially, the reason I wanted to mention this is connected with this article here. Amazon's threat of buying sports rights should freak out the traditional media companies. Whatever avenue they get into, they seem to completely destroy the competition. That's one thing. I just wanted to bring up the fact that you have a company like Amazon, it comes in, it buys up everything, and that's fine. But what if the company that it buys doesn't do well? Does really bad, let's say. For whatever reason, it wasn't a good buy. Maybe it's just a recession. Who knows? Amazon, let's say, is doing great. The company's doing great. The sales are great. The business is great. But this one company that they bought starts doing terribly. And they have to write off a whole bunch of losses. Maybe they have to fire a whole bunch of people. They're in the news. They're being pressured. That could easily take the stock down a level. You could have problems within that company, even though part of that company is doing very well. The other part starts to drag it down. And this is just one example. I'm showing you this here only because it's relevant to today. But you can find this in a lot of different companies like GE Capital. Look at what happened with GE Capital suffering severely during the financial crisis, and that was a huge problem for General Electric a few years ago. That's just one example that we had during the financial crisis. I'm sure you can think of more. IKEA getting rid of 7,500 people over the next couple years, and they're not aware that with the financial crisis coming, it's probably going to have to be a lot more. But essentially, just wanted to mention the fact that in the end, there will be mass layoffs. It's going to happen. And it's usually at the very peak. They're doing a massive hiring spree one month, and the next month they're laying people off. That's usually how it works. I've seen it with my own eyes. Gap looking to close hundreds of stores at malls quickly and aggressively. So this is one company that was just opening up a whole bunch. I remember showing you the statistics. They were opening up a whole bunch of stores, and now we're closing a whole bunch of stores. And then we have so many people sleeping on the streets. It's an interesting article. I mean, it's kind of sad, but so many people are living in their cars and things, and not the people who want to. They want to be living in a house, but quite frankly, they can't afford it. I don't want to cover any more details from that. You know where I'm going with it. Goldman Sachs, the recent stock market plunge does not indicate a recession on the horizon. And I want you to know that Goldman Sachs is your friend. They're telling the truth, and I just want to thank them for reassuring me. Everything is just fine. Thank you, Goldman Sachs. I love you. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And if you want the financial education you were not taught at school, these 2 books have it all. You can get everything you need to know, from the foundation, the history, the asset classes, how to make money, and so much more. Definitely check them out at the link in the description. If you want to see the trailers of the books where I go through them a little bit, you can see that at themoneygps.com. Also, the audiobook is available at themoneygps.com as well. Take care.